Hi everybody, Ray Olson here. Today I'd like to share our first video in a new series to review quarterly performance in the stock market and current economic conditions. Here's what we saw in the second quarter of 2022. Global stock and bond markets continued their downward trends from the previous quarter. The S&P 500 index, a popular headline stock market index in the U.S., suffered its worst first half calendar year performance in decades, while bond markets continued their descent, fueled by the expectation of continued rate hikes. Elevated inflation readings and the looming specter of recession, along with other market influences, resulted in negative performance across all major asset classes. For the quarter, U.S. stocks lost 16.7%, international stocks lost 15.2%, and emerging stocks lost 12.1%. U.S. interest rates increased during the quarter as the Federal Reserve raised the target range on the Fed funds rate twice, from 0.25% to 1% in May, and then again to 1.75% in June. The second rate hike of 0.75% was the single largest rate hike approved by the Fed since 1994. However, markets have currently priced in the expectation of 7 additional rate hikes during the remainder of 2022, with an implied target range of 3.25% to 3.5% by year's end. Now, let's talk about the economy. The final reading for first quarter annualized GDP growth of negative 1.6% showed a contraction of economic output and is the first negative reading since the first half of 2020. The unemployment rate continues to hold steady with a reading of 3.6% in May of 2022, and this coincides with a very tight labor market that saw approximately 11 million job openings for 6 million unemployed workers at the end of April. Headline inflation, as measured by the CPI, closed out May with a reading of 8.6%. This has remained well above the Fed's long-term target average of 2 to 3%, which explains why we have seen such interest rate hikes. Now, what about financial markets? Domestically, all size and style equity categories were down during the quarter. International developed stock markets also posted negative performance, and for U.S. investors, returns were negatively impacted during the quarter by the strengthening U.S. dollar. Emerging markets value stocks were the best performing asset class, and U.S. REITs were the worst performing asset class during the quarter. The economic uncertainty caused by the ongoing Russian invasion of Ukraine, stubbornly high inflation, and the awakening of a long dormant and hawkish Fed caused U.S. and global bonds to lose almost 1% for the quarter and move in the same direction as stocks. A diversified index mix of 60% stocks and 40% bonds would have lost 9.7% during the second quarter. And remember that Buckingham's evidence-driven investing portfolios are strategically invested with a focus on long-term performance objectives. Portfolio allocations and investments are not adjusted in response to market news or economic events. However, we evaluate and report on market and economic conditions to provide our investors with perspective and to put portfolio performance in proper context. And finally, the good news if we have built an investment plan to weather storms such as these. Remember, You're better off having a logical approach, looking at the evidence, staying diversified, and focusing on the long term. Thanks for listening, and I'll see you next quarter.